This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Thank you for joining us on Money Talk today. Here's our lineup. We start with Tom Peckloff of the Ottawa Business Journal. Then we go to an interview with our Philip BNN and Jim Rickards, author of The New Case for Gold, and he's a senior managing director at Tangent Capital. Then after the break, to Brian Purdy, a PI Financial, and he takes a look at the struggling energy services sector. And after the news, my interview with Andreas Koutras, who is a financial analyst in London, England, and we talk about Brexit. But first to Tom Peckloff of the Ottawa Business Journal. Well, it's great to be joined by Tom Peckloff of the Ottawa Business Journal. But alas, this is Tom's last broadcast. Tom, how are you today?
I'm doing well, John. How are you?
Great, thank you. Now, I wonder if you could tell us about your new pursuit, because you're heading on to a new challenge.
Yeah, that is true. Tomorrow I start in the office, Kitchissippi Councillor Jeff Leeper, handling all sorts of different files for the councillor. So it's going to be a very exciting new challenge. Well,
we're going to miss you, and of course we wish you the very best. Now, who will be stepping in to replace you from the Ottawa Business Journal?
You'll be hearing from now on from our print editor, David Sally, will take the reins of our segment.
Well, look forward to that. Now, Tom, this week's Mayor's Breakfast at City Hall heard from the outgoing CEO of Invest Ottawa. The Ottawa Chamber of Commerce Board of Directors has a new chair, and Sengen partner companies gave a live demonstration of their smart city solution at a conference in Berlin.
Yeah, that's right, John. Let's start with Bruce Lazenby, who is stepping down shortly as CEO of Invest Ottawa. His last day, June 30th. He was the guest at the Mayor's Breakfast on Thursday and reflected on his 5 years at the helm of the Economic Development Organization. And, of course, Bruce has always been a cheerleader for the city, and in his speech he called our tech sector, and I quote, probably the hottest tech sector in the country right now. He also mentioned Ottawa as the most business-friendly place in Canada, as he often does, pointing to the burgeoning tech sector, all the universities, research facilities, and the emergence of new hubs such as, of course, the Innovation Center, which will open at Bayview Yards in the fall. He's seen a lot of changes in his 5 years on the job and gave a lot of credit to City Council for making key investments, and also pointed to initiatives such as the Innovation Pilot Program, which was announced on Wednesday. That's where the 8 new products will be test piloted with the city, tested by staff that deliver city services over the next year. Now, Invest Ottawa has given no timetable for naming his replacement. The outgoing CEO does say the next leader must be a strong advocate for Ottawa and promote the region aggressively around the world. As for him, Mr. Lazenby says he's having some wonderful conversations, and he hopes to be back in the fall with some pretty important roles continuing in the city building vein.
So who is the new chair of the board at the Ottawa Chamber of Commerce?
Well, that would be Marie Boivin, the CEO of Accurate Corporation. She was sworn in Thursday for a 1-year term with an option for a second. She replaces Michael Crockett, who has his hands full these days, of course, CEO of Ottawa Tourism. Ms. Boivin said that the provision is to empower Ottawa businesses to reach their potential by focusing on member success, building solid partnerships with key stakeholders, and to foster a modern, innovative, and diverse metropolitan city. And also talking about recognizing the fact that there is more than technology in Ottawa, and the Chamber has to be a representative of all Ottawa businesses, which is pretty refreshing to hear. 2009 40 Under 40 recipient Ms. Boivin has been a member of the Chamber's board since 2010, and also sits on the board of the Royal Ottawa Hospital Foundation, Royal Ottawa Hospital Strategy and Governance Committee. Ian Sherman of Ernst & Young was sworn in as vice chair. And the CEO, Ian Ferris, was commenting on Ms. Boivin, saying that her unique background and experience provides the Chamber the perfect opportunity to engage with key stakeholders.
And what was Sengen up to in Berlin this week, Tom?
Yeah, they were at the 2016 OPNFV Summit in Berlin. Sengen member company Juniper Networks has partnered with Inocybe Technologies on a project that they are calling the Open Smart City Infrastructure and Services Proof of Concept Project. The first live demonstration was held at that conference in Berlin this week. Now, traditional network management sees each service provider operate on its own infrastructure. Now, that leads to complex physical networks, infrastructure duplication, service delays, and, of course, increased management costs. With the financial and technical support of Sangen, Juniper and Innosib have created an open network to accommodate many service providers simultaneously, providing a platform for on-demand city services. Sangen CEO Rich Dussom said that it will deliver long-term economic and social benefits to cities by helping with the management of community services, including schools, transportation systems, hospitals, power grids, water, waste management facilities, and on it goes. Innosib President and CEO Mathieu Lemay said many cities are keen to incorporate emerging technologies to meet their smart city agendas, but just don't know exactly how to do it. He says this solution will support smart cities for decades to come.
And Tom, what's on the OBGA radar for the coming week?
Well, barbecue season is here, John. OBJ, along with the Chamber of Commerce, presenting Ottawa's best networking barbecue Wednesday from 4 to 8 at the Lone Star Ranch, and plenty of other things on the calendar as well. And again, David Sally will be here next week to tell you all about it.
Well, Tom, as this is your swan song, I thought I should mention to the listeners that you have a passion for music, and word has it that you are a very competent piano teacher. So I would like you to give our listeners who would like to learn how to play the piano your coordinates.
Well, thanks for that, John. I do run a small teaching business with a couple other teachers in tow as well. You can contact me at Tommy88@Rogers.com.
So that's TOMMY88@Rogers.com.
That's the one.
Well, good luck, and thank you for all your contributions over the years, and we'll look forward to keeping in touch.
Yeah, that sounds good. It's been fun, John. Thanks.
Okay, folks, coming up, Jim Rickards, author of The New Case for Gold, Senior Managing Director at Tangent Capital. He is a very clever guy, and this interview was recorded with our Philippe BNN just before the Brexit vote.
Gold's had a wild ride in the past month. It has settled down recently as investors believe the UK will vote no for a Brexit. Joining us now for a look at what's been going on with gold and currencies from the Brexit perspective is Jim Rickards, author of the recently released The New Case for Gold and chief global strategist at West Shore Funds. Jim, thanks for joining us.
Great to be with you, John.
So gold's been under pressure the last couple of days, but when we talk about it being under pressure, it's not like we're seeing a massive sell-off. It feels like those who believe gold is going up are lightening their load a little bit and getting ready for the potential uncertainty that lies around the world today.
Well, that's right. You know, John, there are a lot of factors affecting the price of gold, but, it's the best performing asset class of 2016 and best performing asset class of the 21st century. It has backed off a little bit. It was up around, 1305, give or take. As recently as a week ago, it's come down to around the 1260 level. That's all the market repricing for an expected Remain vote in the UK. Now, I find this fascinating because the market's leaning to one side of the boat. The polls actually say this is too close to call. It's interesting, market participants are relying on betting. I could spend an hour explaining why the betting indications are not the best measure. The polls actually are. So it's too close to call. But the market has priced for Remain. So if they vote Remain, it's not going to go down a lot more because it's already priced. If they vote Leave, it's going to skyrocket. So this is a great entry point. I've got an intermediate higher price target, a long-term higher price target. I love the entry point right here because we're priced for Remain. Like I say, not a lot of downside right here, tons of upside.
Well, why? What's your price target for gold?
Well, long-term, $10,000 an ounce. That's the price it'll have to be to restore confidence when the international monetary system collapses, which, it has collapsed 3 times in the past 100 years. The system's very wobbly. When you see people are talking about, if the UK votes Leave, a 10% drop in sterling today, which I think is probably, or tomorrow rather, which is what would happen. Why should currency move 10% in a day? That's ridiculous. In other words, what it shows you, the dollar's down, up 25% from the low in 2011, down 10% since then. Currency shouldn't move 10, 15, 20%. They're not stocks. This shows you how unstable the system is. When the system collapses, which you can see coming, you'll have to use gold as a reference. When you do that, you need a non-deflationary price. So just look at the M1, the global M1 divided by the amount of gold with, say, 40% backing, which is my estimate. That number is $10,000 an ounce. It won't get there tomorrow, but probably in the next 3 or 4 years as the system implodes.
Yeah, it would have to be a big move. I guess, what is the fundamental driver for people moving into gold beyond something like Brexit right now? Is it that we have this uncertainty that still lies ahead once we get through something like this, and sort of a challenge in raising interest rates in a low-rate environment?
Sure. I mean, Brexit is a very big deal today and tomorrow. The markets will reprice very quickly, depending on the outcome. But the fundamentals are awful. You have a collapsing growth in China. The U.S. is kind of hanging by a thread in terms of recession. The rest of the world is even worse off. Clearly, monetary solutions don't work for structural problems. What the world has are structural problems. So there are a long list of factors. At the end of the day, John, the price of gold, the way most people think about it, is just the inverse of the currency. So if you think we're going to have a strong U.S. dollar, then you're going to have a lower dollar price for gold. If you think you're going to have a weak U.S. dollar, you're going to have a much higher dollar price of gold. It's almost that simple. Well, clearly the U.S. has to weaken the dollar to stimulate growth because nothing else is working. We're not getting structural reforms. Monetary easing doesn't work. The only thing left are currency wars. The U.S. is going to cheapen the dollar, already is, relative to the euro and the yen, and that's going to mean a higher dollar price for gold. So now in the very short run, again, it has backed off because of the Brexit vote, but that'll be behind us by tomorrow.
But, I mean, when you throw out a figure like 10,000, which is catches my attention for sure, and you're talking about the relationship between, or the inverse relationship between the dollar and gold, that would equally, I suppose, be your call for the absolute destruction of the U.S. dollar?
No, it's not the destruction. Look, gold went from $35 an ounce in August 1971 to $800 an ounce in January 1980. That 9-year period, that represented, in effect, an 80% devaluation of the dollar measured by gold. In 1977, the United States issued bonds denominated in Swiss francs. People didn't want dollars. The U.S. Treasury borrowed in Swiss francs. That's how unpopular the dollar was. This has happened over and over again. There's nothing unusual about it. So when I say the price of gold's going up, the way I think about it, I use gold as my numeraire, as my constant. The price of gold isn't really going up. It's the dollar going down. In other words, as gold moves from, say, $1,300 an ounce to, $3,000, $5,000, ultimately $10,000 an ounce, don't think of that as gold going up. Think of it as the dollar being devalued. But that's what has to happen to basically create inflation and pay off the debt, because we can't pay off our $20 trillion of debt. These things have all happened before. It happened in the teens, the 20th century, in the 1930s, again in the 1970s. It's every 40 years the system implodes along these lines. Nothing unusual about it. So it's just the devaluation of the dollar, but that has to happen.
And just to play devil's advocate, because those numbers you're throwing around are pretty big. What are the wild cards that could keep the price of gold from climbing at that rapid rate?
Well, it's a strong force, which is deflation. The world wants to deflate. There's no question about that. Demographics, technology, debt deleveraging, all these things are natural deflationary forces. So if we didn't have central bank intervention, I would actually have a lower dollar price for gold, even though in real terms it might be higher, because, as you know, with deflation, every dollar is worth more. So gold could be, say, $800, but it could actually be worth more than $2,000 gold in a world of deflation. So you have to adjust for real terms. But governments cannot have deflation. Deflation destroys tax collections. Governments haven't figured out how to tax the benefit of deflation. They do know how to tax the benefit of inflation. Deflation destroys debt. It destroys banks. It destroys the banking system. It destroys tax collections. You can't pay off your debt. The value of the debt, the real value of the debt goes up. Countries go bankrupt. So countries have to have inflation. So far, we haven't been able to get it. That means they're going to keep trying, and in trying harder, they'll eventually destabilize the system. So that's how it'll play out. By the way, $10,000, it's not a number I made up to get attention. Believe me, it's 8th grade math. Just take the official amount of gold, which is about 35,000 tons, take M1 money supply, assume 40% backing, which, admittedly is an assumption. You could assume 20% or 100%. But at 40%, which historically is what the U.S. has had, it's $10,000 now. So that's the implied non-deflationary price of gold, not a made-up number.
All right, Jim, appreciate your thoughts. Jim Rickards, author of The New Case for Gold, joining us from the NASDAQ market site in New York, also the global chief strategist for West Shore Funds.
Okay, folks, after the break, Brian Purdy, who is an analyst with PI Financial, and he's been raising his oil price projections and has some favorite names in the struggling energy services sector. Stay with us. This is 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
We're joined by Brian Purdy, energy analyst at PI Financial. He's in Calgary. Brian, thanks so much for coming on the show.
Good morning, Andrew.
Just remind us what you see for WTI over the next couple of years. Have you increased your forecast for prices?
Yeah, just recently we did. The prices had come up a little more quickly than we had expected. And we see the oil price going into the mid-50s next year and then up to $60 in 2018. And, I think there's even a bit of upside from there. You've seen the low oil price cause certainly a pullback in oil service activity that's been unprecedented in recent years. And as well, now you're starting to see some geopolitical issues in some of the producing countries that are really dependent on oil for their social programs. So, we're seeing production coming down in those areas as well. And that's started to move the prices higher.
What about the end of 2016, Brian? Do you see oil prices much higher?
I think it's going to be a slow and steady rise. We're going to see some back and forth a little bit, but I think we could go into the low 50s by the end of this year, and that's a far cry from where we were in January.
Well, you follow the energy services companies pretty closely. You have some ideas. Obviously, they're volatile plays, some of them very damaged balance sheets. But let's start off with a name that's kind of unusual. They're active in Papua New Guinea, High Arctic Energy Services. This is one of your favorites?
Yeah, we've liked this company for a long time. They, as you mentioned, have a lot of their activity coming out of Papua New Guinea. And they have basically sailed right through this downturn that's devastated the North American service companies. They've continued to increase their revenue and cash flow, and we think they're poised to do an acquisition in North America, take advantage of some of the really beaten up values that we see here, and if they're able to do that, they're going to be able to benefit from the rising activity in North America once that oil price gets up towards $60. We think you're going to see that, and there should be a big lift in the values if they can execute on a transaction before then.
And that's fascinating, isn't it? Because management teams must be tempted now to look at acquisitions with valuations down.
Yeah, acquisitions and M&A in general has been a theme in the E&P sector already. Mm-hmm. I think on the service side, we're a bit behind that, partially because balance sheets have not been in great shape for many of the companies, and financing and lending activity has been down as well. But High Arctic has a lot of internally generated cash flow, so we think they're going to be one of the few to be able to take advantage of this market.
And speaking of M&A, give us your take on this turmoil in Alberta on who has to pay for old abandoned oil and gas wells. It looks as though liquidators won a court ruling saying they can just wash their hands of these things. We've heard a suggestion that if they bring in tougher rules on cleaning up old oil and gas wells, it could make it far harder to take over companies.
Yeah, so the Alberta Energy Regulator, AER, put out a directive this week saying that they're going to require a higher standard of assets to liabilities for companies that wish to acquire new properties in Alberta, the oil and gas properties. And so, that may slow down M&A a little bit in the province until companies get themselves organized around this new standard. Mm-hmm. It's certainly shrunk the list a little bit of the players that can get into the market and maybe made some of those properties that have more liabilities less desirable. It remains to be seen whether this new standard is going to be just an interim measure or a permanent measure. There's still an appeal ongoing between the AER and the courts over whether in a bankruptcy proceeding, does the AER still have rights over all properties, or can they be forced to take back some of these liabilities while the more profitable properties are sold to satisfy some of the liabilities. So it's definitely going to slow down the M&A market a little bit in the near term, and we think that might prompt a little more activity in the service side as companies try maybe to drill to get their ratios more in line or remediate some of their liabilities to get that ratio up. And the AER publishes this ratio, the LMR, every month for all the E&P companies. So, we'll be keeping a close eye on that to see which of these companies are coming up to this 2.0 standard that they have to get to now.
Sorry, just walk us through that again, Brian, would you? the ratio. What's that about, and what does LMR denote?
Well, it's basically a ratio of the deemed assets to deemed liabilities, and the AER has their own formula for calculating what what those deemed assets and deemed liabilities come out to. Mm-hmm. But basically, in the past, you just had to stay over 1.0 just to keep your assets and liabilities at least equal. Now you're going to have a 2.0 ratio and have your assets double your liabilities. So, but that's only if you want to acquire more properties. If you're just operating or drilling, then you still only have to meet the 1.0 standard. So it's really only a factor in the M&A market, and as I say, it may only be an interim issue. We don't have all the results of the appeal that the AER is going to make yet.
Mm-hmm. Right, but quite an increase in the threshold, all right, for M&A. You have another company for us, Canyon Services. You like the look of this one?
Canyon, yeah, we do like. They are focused in Canada on the fracturing market, and the fracturing market's probably in one of the most beat-up areas. Canyon has a debt-free balance sheet, which I think is going to be an advantage for them as well. With this ruling out of the AER, we think we might see a little more activity. Plus the rising price, I don't think it's going to spark a huge amount of activity, being close to $50, but probably more than we saw in the first half of the year. So you're going to see a bit of a pickup there. And some of these companies that have been losing money and then transition into profitability, can see the biggest lift in their share prices. So that's probably not coming until near the end of this year. But we think Canyon's going to be well positioned. It's not one that has a lot of debt that might run into problems with their lenders at this point. So it's a safe bet on a turnaround that could be dramatic as we see higher commodity prices.
And then on the exploration and development side, you just started covering a new company that we haven't heard much about, Petrus Resources. I think the market cap's only about 80 million. What are they all about, Petrus?
Petrus has 4 operating areas, but the big one that they're focused on right now is the Cardium. They have a number of properties in the Ferrier area, and it's liquids-rich natural gas. We're starting to see prices for natural gas now improve as well. We're having quite a lot of air conditioning demand out of the U.S. this summer that's whittling away some of the oversupply that we've seen. And we really do like the management team at Petrus. Kevin Adair has been the VP Exploration at Spry in the past, and a lot of the rest of the team came from Peyto. So they have a lot of experience there, and they're doing well in the Ferrier area. And that play becomes economic for them in the mid-50s range. So we're expecting to see a small amount of drilling here in the second half from them, and then that will probably accelerate as we see higher prices into 2017.
And of course, for smaller players like this, the cheaper availability of services has been such a boon.
Yeah, you've seen well costs come down 30% or more in some cases. Certainly land is available for anybody who's willing to try and acquire more in their core areas. And Petrus has been doing that as well. There's a lot of farm out and property swapping opportunities out there. So if you have a bit of flexibility on the balance sheet or a good hedging program, you can certainly do well in the E&P market right now.
Good stuff, Brian. Thanks so much for joining us.
After the news, a 2-part interview with Andreas Koutras. Stay with us. This is 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
Well, it is 6 in the morning on Friday, the 24th, and we have just heard the news of the vote on the Brexit. And I'm joined by Andreas Koutras, who is a financial analyst and is a Greek citizen, and he's been living and working in London for the past 33 years. Welcome, Andreas.
Good morning.
Britain's got a hangover this morning, and it looks like the EU party is over.
Indeed. I have to say, it's not a big surprise to me, because I was getting these messages throughout the past 3 weeks, and I was not very optimistic about the result, and unfortunately, because I was on the Remain side, and finally, this is what happened. So we're in for a very messy divorce.
Now, you and I seem to talk every time there's an exit gathering, and that the last time we talked was during Brexit. What happened?
What happened is it's not a long story, but you can actually pinpoint 2 major events in the history. We all know that Britain had a somewhat, difficult marriage with the EU. Since 1972, the relations were not that great. The British always, wanted something else out of the EU, and the EU never offered exactly what the British wanted. But I think the key events are the 2008 crisis is the one event, and then the other event is the 2003 enlargement of the EU. Now, let's take them one by one. In 2003, there was the enlargement, the big enlargement, where 27 countries altogether. It was, I can't remember how many they joined, but basically EU expanded eastwards, including countries like Poland, Lithuania, Bulgaria, and other countries from the former Eastern Bloc. Now, that was quite okay, but at the same time, what it meant for the most, let's say, successful, apart from Germany, British economy, there were lots of jobs, well-paid jobs, and very soon, roughly speaking, 1.9 million of EU citizens relocated from the rest of Europe to Britain. Roughly speaking, I know the numbers, it's 800,000 Polish people, around 250, 300,000 Romanians, 300,000 Germans, 250,000 French, and so on and so forth. And that does not count the people who actually moved in for a few months only, let's say on a summer leave or something like that. So we're talking about people who actually relocated permanently. Now, obviously, that created a lot of tension in the local communities in England and in Britain. But the major event that happened in 2008, which is basically the crisis, the banking crisis or the credit crisis, broke basically the trust between the people and the politicians. People started doubting, not just in Britain but in many other countries, the ability or the truthfulness of the political statements that the old political regime, let's call it old political regime, was making. So what we have now is we have a reaction towards the old political system. Now, unfortunately, that reaction, which could be, one could say is well-founded because of the failings of the political system, was basically exploited by populist politicians like Mr. Farage in Britain, like nationalistic and populists in Le Pen in France, and like the Syriza party in Greece, and most probably this Sunday with the elections in Spain by Podemos. So we have this breaking of trust between the people and the political class, or the old political class. And now, with this referendum, basically, the British people said, we don't believe anything Mr. Cameron says. We don't believe that he can contain the EU. We do not believe that the economy is going to go really, upside down if we leave Europe. We don't believe experts is the famous saying. We don't believe this anymore. We want change. We want something else. And that gap was filled, unfortunately, by nationalistic, populist policies. So this is basically what we've witnessed in the UK.
And David Cameron has announced his resignation. I guess what I'd ask is, what's next, not just in Britain, but in Europe, because Marie Le Pen will obviously take heart from this event, and Denmark and Italy and Austria. This has set the cat among the pigeons.
Absolutely, absolutely. You have all the so-called anti-systemic parties being very jubilant about this. Even the Nazi party in Greece is actually very outspoken and jubilant about the, Britain exiting the EU. So where we go from here, it's very interesting. I can speculate, but you have many countries and many political parties that they base their success on these policies of populism and nationalism. We had that in Spain, we have that in Greece, in Austria very recently, in France. In Holland, the opposition already asked for a referendum to get Holland out of the EU. So you do have a serious challenge to the status quo of the post-war European politics, a very serious challenge. And obviously Britain succeeded in this challenge, and to be honest, the change in geopolitical regime of the Second World War is something which is very interesting and perhaps very dangerous.
Now, you and I are both from the financial markets, and I have to ask you, what are the implications? I hear the pound hit 30-year lows overnight, and we are waking up here in Canada to a decline in the Dow Jones. All the central banks are into full action. So what are your thoughts on the broader implications?
Well, a couple of weeks ago, I made this mental exercise trying to go through what is going to happen. And one of the scenarios is like, that is probably going to be bigger than the Lehman effect or the Lehman crisis. Not as intense as Lehman was in the first week, because Lehman was an abrupt event. Within a week, you had an intense effect. But the effects of Britain moving out are going to be felt for many, many years. Because let's see it. What's going to happen is that for the next 2 years, once Britain basically activates Article 50 of the Lisbon Treaty, in other words, give notice to the landlord that they're going to move out, basically they have 2 years to negotiate an agreement, an exit agreement. Now, these 2 years, obviously, if you're a businessman and you want to invest in Britain, you don't know where you're actually stepping because you don't know what the final agreement would be. So would you invest in Britain? Well, I think they're going to have second thoughts. Then you have also the fact that markets are repricing the very high risk of other countries joining in Britain in actually exiting the EU. So I think the combination of basically the falling pound, the recession in Britain, which is bound to happen, in my view, and the lower demand is actually going to push commodities down. It's going to push gold up, obviously, because of the uncertainty now in the system, and it's going to push flight to quality that we have already seen. You know, people are going to fly perhaps to the dollar, to the Swiss franc, to the yen. So you're going to see a lot of funny movement as people rush into the safety of assets that they think are going to be safe. So, for example, the euro may not be an obvious hedge because both Europe and the euro and sterling and Great Britain are going to go through a messy divorce, and that's not good for either of these currencies.
Andreas, I'd like to break for a moment, and when we come back, I'm going to ask you for an update on Greece. I believe you ran for Parliament.
Not this time, but the first time, back in January 2015.
Then I want to ask you about the health of Northern European banks. So we'll break for a moment. Stay with us, folks. This is 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
I'm back with Andreas Koutras, who is a financial analyst and an old friend who is in London, and he's a Greek citizen who's been living in London for 33 years, working in the city of London. And we've been talking about the news overnight that Britain will be exiting and the historic vote last evening. Now, Andreas, we were talking about the fact that the party was over and that there are big changes in effect in Britain, but also for world financial markets. I wanted to ask you about Greece, because the last time we had an interview was during the Brexit, and where does Greece stand at the moment? And then ancillary to that is, what is the situation with the big Northern European banks like Deutsche Bank?
Okay. With regards to Greece, I mean, after the last year's events where basically the Greeks voted in a referendum, actually almost to the day a year ago, it was 5th of July that the Greeks held their referendum. In that case, they actually voted out, effectively. They voted to reject the offer by the European Union. But then the Prime Minister changed his heart and he made the out in. Now, unfortunately, I don't think Cameron can actually do such a trick because he's not Greek. So Greece has gone through a very sort of calm period for the past few months. However, the underlying problems have not been solved, and unfortunately, the economic situation has deteriorated even more. Now the government, which is exactly the same left government that we had in the first part of 2015, is actually doing everything that the European Commission is actually saying to them. Things on the ground are not looking very good because they've lost a lot of time, ground, and money in actually pursuing policies that were, let's call them, lunatic. So I think that Greece is in a very difficult position, and it will be in a very difficult position in the next few months when all the tax rises that this government has actually passed are going to start kicking in. People just don't have enough money anymore to pay taxes. So, unfortunately, Greece is in a sort of very precarious position. And one of the main reasons is that the Greek banking system is in a zombie state. There are 4 major banks, 4 systemic banks in Greece that basically they have half of their loan portfolio. 50% of the loan portfolio is actually non-performing loans. Now, when you look across Europe now, going to the banks in the rest of Europe, you see a mixed picture. You see that in some countries, they sort of manage to raise some equity and try to improve their ratios. However, in others, they have not. So, for example, we still have a problem with non-performing loans in Italy and other southern European countries, whereas the problem in Germany with the banks seems to be smooth. If not smooth, then they are hiding it very well. But definitely, if there is a recession, and if Britain is going to kick a recession in not just in Britain but in Europe, we're going to see some of these big banks suffering.
There's an old adage, and it comes from the Depression: if you owed the banks $1,000, you had a problem. But if you owed the banks $1 million, they had a problem. In this instance with Greece, how much money does Greece owe the banks, meaning the northern banks like Deutsche Bank, etc.?
Actually, the banks themselves they have been out of the system for so many years now that they contain the problem. It's mainly loans to the Greek retailer or the Greek businesses that they actually have the problem. The Greek banks have a domestic problem. They are simply not being paid by the people who lend the money to, and that's the biggest problem. On the other hand, German banks now don't have any exposure to Greece. The exposure to Greece basically has gone through the process of if you remember, the restructuring of the loans and everything of the bonds, almost to zero. So tomorrow, if Greece actually defaults, the actual financial effect, economic effect to other European countries and banks is going to be zero.
Now, is this a case study, Greece, a case study for other weak European countries?
Greece is a very exceptional, unfortunate case. And why am I saying this? Because the Greek problem did not start in banks. The Greek problem started in the massive debt that was accumulated by the state. So it was the profligacy of the state, not of the banks. Banks, more or less, they had an inflated balance sheet, bad loans, but they did not cause the problem directly. So this is why we first had basically the collapse of the state, and a couple of years later, the collapse of the banks. However, nowadays, and you know that some well-known Canadian investors have actually invested into Greek banks, thinking that the worst is over. It seems to me that the worst is not over, at least for the Greek banks.
We've used the expression kicking the can down the road for years, but the can has stopped. You can't kick it anymore. I'm not going to let you off the hook without some forecasts regarding financial markets. And so what do you think is going to happen to European interest rates?
I mean, they cannot go lower than minus 40. I mean, they could, I guess, go to minus 1%. Right now, they're minus 40 basis points. The unconventional monetary tools that the ECB, but also the Fed and other central banks have employed have run their course. I think they're approaching the limit of diminishing returns. I really don't know what else they can do.
Would you buy good European stocks on this news?
If they go down a bit, yes. I think you should buy some good European stocks. But on the other hand, I think that if there is a repricing, the repricing of the political risk of Europe is going to affect all equity markets.
What about the value of the euro going forward and the value of the pound?
Well, it's quite clear that the value of the pound is going to be repriced much, much lower, between 10 and 20% lower from the highs, with respect to at least the dollar. With respect to the euro, I'm not so sure. I think the euro has also problems because they are the other side of the equation between Britain and Europe. So it seems to me that it's not going to fall as fast with respect to the sterling. I do think, however, that currencies that are traditionally seen as safe havens, like Swiss franc or perhaps the yen and even Norwegian krona, might actually jump up a bit.
Andreas, you've got some very interesting statistics for us.
Yes, with respect to Brexit, I mean, just look at Britain, for example. Something like 41% of the global FX goes through London. The three major crosses, basically, the three major currencies, euro, dollar, and yen. It goes through London, 41%. Does anyone have any doubt that once UK leaves Europe, leaves the European Union, that the Germans or the French, so basically the ECB is going to do everything in their power to actually take the trading of euro from a non-EU country and bring it back to, let's say, Frankfurt or Paris or some other EU center? That's going to be a loss to Britain. Another interesting number is that out of the 9 trillion of funds, euro funds, called usage funds, about 1 trillion is domiciled in the UK. Now, if the UK leaves, and now we know that it's going to leave, this 1 trillion would have to relocate into an EU country. Basically, Ireland or Luxembourg are the two major destinations. So you see now we have a stream of unknowns with regards to the financial sector in the UK that's going to affect not just jobs, but the financial health of the UK. The UK has a deficit, a current account deficit with respect to the rest of the world. But in the financial sector, is not the only one, but it has not a deficit, it has a 71 billion worth of exports. So this is the one place in the economy that the surplus is 71 billion. And UK is actually risking this 71 billion worth of euros of surplus with the rest of Europe. I think that their decision to actually leave the UK is going to be suicidal with respect to lots of financial services. Another one is the insurance industry. I don't know the numbers, but we all know Lloyd's in the insurance industry in the UK. It's by far the biggest insurance industry, and it is actually based in London, and they use their passport to the rest of Europe. Now, what's going to happen? They're not going to be able to actually passport that anymore, or at least until the agreement sets the rules, they're going to be left without any agreements and with lots of unknowns. So what you have in here is that you have a huge possibility of total destruction of the UK's financial system, not only for that, but because, it has long been known that the French and the Germans always wanted to actually move a lot of these financial services away from London and into Frankfurt and into Paris and in Milan or any other European country. And now they have been given the perfect, chance to do it.
So last night was a high-stakes poker game, and Britain is going to have to live with the consequences.
Britain has to live with the consequences, and not because the people actually said that we don't believe in economics, we don't believe in the system and the systemic policies and politicians anymore. We want change. And Mr. Gove, which is one of the leaders of the Leave campaign, actually said that clearly in an interview. We do not need experts. When he was confronted with all the economic analysis from independent people, independent economists and experts that exiting the EU is going to hurt the British economy, he famously said, we don't like the experts. We don't need the experts.
Andreas, I wish I had more time. This is fascinating, the best early morning chat that I've had in a long time, and I want to thank you so much for joining us on Money Talk, and we've got to talk sooner than the next exit.
Well, the next exit might actually happen sooner than we think.
Okay. Well, take good care, and thank you, and enjoy your weekend.
Thank you, John.
Well, folks, thanks for joining us today on Money Talk. I hope you're enjoying a good holiday weekend and a happy Canada Day. I'm John Budden, wishing you the best in the battle for investment survival, and you are listening